Right, hello everybody. Just checking my webcam is coming online. Yes, I can see myself. Can you hear and see me? My microphone is active. Everything should be fine. There's 10 people at this moment in attendance. Can you guys hear me? Owen. Oh yes. You're a regular. I hope you're learning a lot. I hope you're making progress. Right. Anybody else? Can anybody else hear me? See me? Everything is fine? If you can hear me and see me, just please put in yes in the questions section. Anybody else? Owen, it's only you that said yes, so maybe the rest can't hear us. 12 people now in attendance. If you can hear me, if you can see me, please just type yes in the questions box, so I know everything is fine. While I wait, I'm also going to ask a few other questions. Right, Owen, especially you then. Seems that you can hear me and see me. Ah, there's some other people. Leonard can also hear me from Zim. Ah, welcome, Leonard. Right, I want to ask how many of you guys that are actively using the moving average spring strategy? Just going to drag the box here so I can see. If you're actively using it, just reply yes as well. Owen, not yet. Okay. Is anybody else actively using this just to enter, to take trades, to look for setups in the market using technical analysis, using this method, simple, well-defined method to try and get entries so that obviously you can make a net profit over a series of trades. Right, it seems nobody else. Okay, if you are, you're just too shy, just I want some feedback. I want to know how are the guys finding it, if they find it useful or not. Any suggestions? I had one suggestion that the moving the fractal indicator that I put up is a little bit complicated. So what I did is I'll show you now. I changed it a little bit to make it a little bit easier to use. So, but feedback, please remember, feedback is very important for us guys. I don't want to talk to myself. In the seminars, we stress that it's interactive. So we don't just want to monologue. We want to hear what is your feedback. Your feedback helps us to make our presentations better, to focus more on what you guys want to hear, to train you, so you can become more successful. That's our purpose. In the end, if you don't become more successful, then it means that we must change what we do. Right. So let's start with this one. You'll see I've made some changes. Every time we have interaction with people, you learn and you grow. People are so versatile, so unique, and every person's perspective, every person's feedback is important. So what I've done is I've changed my the gift of online trading. This is actually the second part 2 of the gift of online trading. I've changed to the foundation of online trading. People seem to grasp the concept better. Right, so we're going to talk about the moving average spring strategy, but we're going to apply it. Right, so in the end, I want you to have some simple, well-defined method that you can apply, that you can use on your MetaTrader on the markets to identify trades for you. Right, so let's get started. This is applied, so I'm not going to go through the whole thing again of what the method is. If you're not sure, you can go to the my FXTM recorded to education to webinars. I think there's 2 recorded webinars about the moving average spring strategy. So that's where you'll see the details of it. Right. Just think, so one thing I want to state very, very clearly. Always remember, we are doing technical analysis. We're not analyzing what caused the news, what caused the prices to move. We are studying what the effects of that. And technical analysis, I still get a lot of people that don't understand the full definition of it. Now, if you don't know the full definition of technical analysis, then you're going to struggle. You're going to be very easily trapped in the entertainment part of of trading, and you're going to miss the business part. Right. So the entertainment part is when you look at indicators and you focus on the indicators and all those type of things. You don't focus on the price, the underlying structure of the market, the rhythm of the market. You don't see that. Now, if you don't see that, then you've got an issue. So what am I talking about? It's all captured in very nicely in the definition of technical analysis. What we do is we study market action using price charts. And just for interest sake, this I don't just get this. We don't just get this definition from the internet somewhere, somebody's opinion. It comes from a guy that wrote a book about it, a very comprehensive, well researched book, John J. Murphy, Technical Analysis of Financial Markets. So that's very important when you decide to use a definition. Check how much research does it go, how much substance, how much depth has the definition got. So we study market action using price charts, but why? And a lot of traders cannot answer that. Why? Why do we study it? The definition, the second half of the definition is for the purpose of identifying a new or the next trend in its early stages. That's it. Nothing else. Now, if you accept that definition, it's going to help you a lot. You're going to stop over trading. You're going to stop jumping around in the market. You're going to stop being confused because you know now. We are trying to identify a new trend. Let me just get the cursor there. We identify a new trend or the next trend in its early stages. That's it. So what does that practically mean? We have to see and to understand on the charts that we see before us the structure of that market. There's waves, there's patterns. Now, waves is not unique. You get light waves, you get ocean waves, you get sound waves, heat waves, all sorts of waves. And all those waves have the same characteristics. They've got rhythms and patterns in them. And our market is the same. Even just on this picture that I'm looking at, this chart I'm looking at, I can see rhythm there. I can see there's an uptrend going there. There's a downtrend going there. Uptrend. If you cannot see that, how will you know when to enter? And remember the definition that we just said. We're looking for that. We identify the early stages of the new trend. Early stages of the new trend. Early stages of a new trend. That's where our risk-reward ratio is the best, right? Just sweeping over this, guys. And we call it the flow and the rhythm of the market. You have to see that. If you cannot see that, then you're blind. You're going to start focusing on the indicators, and that's not going to work. The purpose of the indicators is just, it is part of a simple, well-defined method that helps you to identify these things, to help you to know exactly where to enter when it gets to that point. Right? It's not going to help you if you apply your method to all sorts of different, in the middle of a trend, you apply your method. You're going to bomb out. So you're going to have lots of losing trades. So you have to identify that sweet spot there. But we look at that now. Okay. So this is in essence what I mean. This is the Euro USD on the 4 hour, and this is I chose this. It's not always so beautiful. There's sometimes there's sometimes ranges, but I just took a snip of this, a screen print of this, because I want to show you what it means. Here we see the market going up. It's an uptrend. Here it begins a downtrend. That's the areas we look at. That's the sweet spot. That is we identify the new trend in its early stages. That's the new trend, a new trend in its early stages. That's a new trend in its early stages. That's a trend. That's a new trend in its early stages. You must be able to see this without any indicators. I just put the trend lines here. We're going to look at a few examples now, where from on a live chart. You must be able to see those areas. Those are the areas that's going to make you successful in trading. Those are the areas where your method, your simple and well-defined method. In this case, we're going to overlay this moving average spring strategy there to just see how it helps you to identify a place where you know exactly where to enter, exactly where to protect your account if the market does not do what it's supposed to do, what you expect it to do, exactly where to take your profits and so forth, right? So let's go on. Here we've got a naked or a chart. That's the areas. That's the changeover area. There we We enter, we look for an entry there, we manage there. There somewhere might be a possible entry, we manage there. There might be a possible entry, manage there. Definitely not with every changeover, you're going to get a perfect setup to enter. So you have to practice on old charts your method, this flow and rhythm to see it, and now you overlay your method to show you where the entry points are. You must practice it so many times that you don't get confused in the real markets. You don't get confused in the real chart and take those type of trades which afterwards you say to yourself, how on earth did I, what did I think when I entered this trade? We want to eliminate those trades by practicing our method very comprehensively. Okay, let's look at a couple of examples on our chart. Right, so I'm just gonna blindly go. I'm gonna choose the daily Euro USD. So, and what happens is a lot of people say they get confused. They don't understand, they don't see it. Okay, normally it means that you zoomed in too much. You want to get a distance view. You want to look from a distance. So some people even they have difficulty seeing the structure. Then zoom out a little bit. You must clearly see the uptrends, the downtrends. There's an uptrend. There's a bit of a range. There's a clear downtrend. Create for yourself a naked chart, we call this, where there's just, if I zoom in a little bit, it's just the candles, right? And make it a template, and then now and then, especially in the beginning, if you find you get confused, you don't know where to enter, go on to any time frame. I always tell the guys, if you want to really train, go from the monthly to the 1 minute. You open this chart, you zoom back, and you start looking. You start looking for that structure, because the moment you can see the structure, you'll be able to see that sweet spots, the changeover when the balance between the buyers and sellers change. All right. So again, that's just a practical definition of technical analysis. We identify the new trend in its early stages. Right. So there I see a trend. Not every trend is going to be perfect. That's another reason why I have to train on real charts a lot to get your eye in. This is a daily one. There was a long one. It's so clear there. This was just a mish. There was a possible one. There was a one. Remember the definition of a trend: consecutive tops and bottoms, either up or down. There was perhaps one. There was definitely not one. That was a ranging market. That one was too short. There goes not too short. There's one. So draw it in so you can see for yourself, and it's going to start helping you to identify the changeover places, that sweet spot. There was a possible sweet spot. We've not taken the outlets. Right, let's go to another time frame. On different time frames. The fractal nature of the markets. Let's go to, let's say, a 4 hour. Again, what do we see here? Here we see nice trends. It's not such a nice one. Is it 1, 2? Yes, that's a trend as well. There was one as well. We're not trying to enter yet. We're training our eye to see that, to see the structure of the market, the flow of the market. Because in the end, as Bill Williams says, we want what the market wants. If the market doesn't want to go higher, we don't want to go higher. If the market wants to go lower, we want to go lower. And the market will give us certain chances at the early stages of a new trend to enter with a very low risk and a very high probability of profits, and that's what we want, right? So just take one and start training your eye. You see, there's like a super trend, but that will be a trend on a higher time frame. Here we're looking for the normal trend. 1, 2, there's a trend there. Possible. That's a possible turnaround there. And what you'll see immediately, and that's what a lot of people don't want to acknowledge, is do you see a lot of perfect ones? No, you don't. Over trading is caused when people they want to see it. They want to see it so badly that they actually start seeing what is not there. The market doesn't give you a good entry every now and then. You have to wait for them. You have to be patient. That's the reason why Warren Buffett said markets are instruments for transferring funds from the impatient rather, to the patient. So markets are instruments for transferring funds from the impatient to the patient. If you're impatient, if you jump in and out of the market, you don't wait for those sweet spots, those areas in line with technical analysis, then you will pay. Then you will lose your account. You will blow accounts until you can see the structure, until you can. Let's see if there's another one. One, two. No, that's not one. There is another one there. Lively one. Right. Breaking out there. There's our sweet spot. Right. That's the 4 hour. Let's go to the 30 minutes. And if you even have to go further back, so be it. You want to see that flow. You want to identify that flow. We only want to trade at that sweet spot when there's a changeover. When it's the early stages of a new trend. Here you'll see on the lower time frames what I said always, it's more noise. So it takes a little bit more training to see those things. I think I'm marking the super trends here, or the higher time frame trends. Let's zoom in a little bit. Right. And if you don't see it, it's not there. Is there a trend there? Let's see. 1, 2, 3. Yes, there's one there. There we didn't get a decent entry, but it's a trend. And there's a changeover. You must be able to see those ones. Right. Go back. There's no stress. You're just training your eye. No stress. It's just you're busy training yourself, training your skill. Right. Go to a lower line, the 5-minute one. Always we see the structure there. What do we see? Let's look for the ones that's not right. There might be one, a little bit of a rough one. There's a beautiful one. And there's a nice changeover. Those are the ones we're looking for. Not gonna get one every day. Luckily, there's a trend on any time frame, and there's so many currency pairs that we can look at it. Okay, now we scanned through a couple of them. Okay, Elijah. Oh, he's left. He said, straight to the point. I don't want so much data. Right. Okay, Elijah's left. But the reason, guys, why I go through this is that people take a method, they think it's going to make them rich, they focus on it. So I always want to set the record straight. This method is useless. It means nothing if you don't understand that flow and that rhythm. So it's actually, you can at some point, you don't even need the method anymore. You can see that entry points. All right. But Elijah is right. We're not going to go there too long. Very quickly. Method has to be well-defined, simple and well-defined. Our method is we want a confirmed trend. We want a breakout. Price above the 34, pull back to the 15. I'm going to show you what I mean here now. I changed it a little bit, the practical. The first fractal after the 34 breakout, a pullback, and then we enter at that first fractal, right? And the momentum. Exit rules, also important. You have to be defined. We put it at 34. First take profit, high probability trading. First take profit, we take some at the shorter distance, and the other one at the longer distance after we've entered. Right, very quickly, there was a downtrend there. It broke through the 21, it broke through the 34, pulled back to the 15. There's our first fractal, decent fractal turnaround point. That fractal turnaround point is actually the same terms. That's the purpose of the indicator. That's our first one. It pulls back, gives us a second one. Not always necessary. When it goes past that first one, that's the change I've made. It goes past that first one, then we take it. That's our entry. Stop loss is at the 34. And our take profit is at the first one and the second one. Okay, so just this is just a benchmark, right? I think let's go and look for a few of them on the charts. That's the purpose of this thing. Right, let's look at the 4 hours. First, we put in our moving average. Remember, we must be able to see that structure, guys. You see the structure there, all the changeover points. Let me mark it for you here. Without the structure, this method is useless. It will not work for you because you want to jump in every now and then. So let's overlay the structure here. Then I'll delete the trend lines now. Right, there's a couple of, I chose this one because there's a couple of easy ones here. So we can see. We'll take a more difficult one now. So what are we going to do now? We overlay our 34, first one. You can immediately see what's the purpose. It's helping us there to identify the longer term trend. Pullback, we've got the 15. Let's take a red one there. Right, it helps us with the pullback. Okay, let's zoom in a little bit. Right, I'll take the trend lines away now. Okay, we put in the fractals. Fractals does bring in a little bit of noise, but it does help if you zoom in a little bit more. So we'll zoom in a little bit more now. Okay, and then obviously we want the moving average. We want the default one. Right, there's the one. Right. Okay, so let's zoom down. So can you see now the structure? We see the structure, we see the changeover point. You see the structure. So now I'm going to quickly take away the trend lines. There, we're gone. Right, let's zoom in. What are we waiting for? We are waiting for a break. Can you see it? A break through the 34 moving average. This one piffles a little bit, goes a little bit deeper. That's a little bit of noise. We call it nooks and crannies. There's a very nice turning point. It's a bit lower than that one. Right. So, and then the market starts going up. That's what we want. We want it to start going back to the 15 moving average. Does it make sense? Can you guys see what I see? Let's zoom in a little bit more. Okay. Just checking here. I'm checking if you guys can still hear me. If you can see what I see, then please, yes. Owen says yes. Okay. Right. So this is an example. We've got our uptrend there. It broke through 34. Went a little bit back, but it's not a decent pullback there. Made a fractal there. That's the lowest fractal before it went back to the 15. Made a fractal there, and then it turned around. So what do we do here now? This is where we want to enter. This fulfills all the simple, well-defined rules that we have. We've got 34 there. That's our stop loss. And we enter there. And a couple of guys have also asked, how do we do it? So, like I told you, if it's in a short, very short time frame, let me just put in the other ones. This is where our stop loss is going to be, our first stop loss, 1 to 1. And this is where our second stop loss is going to be, 1 to 2 of our risk. That's our risk, 1 to 1, 1 to 2. Right. So how do we enter here? If it's a very short time frame, you can enter with, you do your lot sizing here. Let's say, for instance, this is 10 pips. Let's say let's look what it is here. Okay, it's about 37, let's say 38 pips here. Right, I'm going to give you an example. Then we have, we're going to simulate this properly now. Okay. Right, I'm going to go to a site that very easily helps you with the lot sizing. There's a couple of different ways to do it. Where's that now? Lot sizing, lot sizing, lot sizing. Have to open that one now first. There. On our website, we've also got one, but it's not as easy as this one. So let's say, for instance, we have $1,000 US. This one is my FX books one, very comprehensive. We want to risk, for instance, 2% on a trade. What did we say in this case? It's a Euro USD, yes, and we worked out our. We saw the fractal there. We saw it's busy pulling up, and when it pulls up and starts coming down there, we know this might be a possible entry. So we're going to put in stop orders here, right? If it's, I will talk about now. Okay, so we have to work out what is the position size if we have $1,000 account now here, right? So we worked out it is, let's say 38 pips. Our risk is 38 pips, 0 USD, and it shows us we have to enter by 0.5. Right, we have to round it off. We're going to take half of our profit, so I'm going to round this off to 0.4, a bit lower. So there we would place either one position if it was a lower time frame, one position where we enter a stop order with 0.04. And because it's a lower time frame, we can sit and we take partial profit there, and there we will put the final stop loss, and obviously our stop loss will be there and our final take profit. Right? If it's however a higher time frame, we can't sit in front of the computer the whole time. We simply, what we do is we split this in two. We decided it's a 0.04, so there's going to be a 0.02 and a 0.022, 0.02 orders here. Both stop losses there, but one stay profit's going to be there and the other one there. Then you don't have to sit there. The market, in that sense, you might, because if you've entered a trade, you don't have to be there with every candle. You must give the trader room to breathe or room to move. So you're going to watch every third or fourth second or third candle. There, after your first one, your first profit was in the box, and after the second, after the second one, your first take profit, and then after the second one, touched it there, then you took it finally. Right, so there's an example. Okay, did everybody get that? Peter said that I didn't understand the entry point. Okay, let's explain a little bit better. What our technique says is we wait for a break through 34. You understand the break there? Peter, do you understand the break through the 34 there? That means we are, it's the early stages of a new trend. Okay, I'm assuming you do. So what happens here, we're waiting for a nice down move and then an up move back to the 15. Now at this stage, the 15 is still up there. So this one is not really, it's not really a valid pullback here. We wanted to go a little bit lower. So here it did go a little bit lower, and we like that fractal. Okay, so it went nicely down. That was just a nook and a cranny. It went nicely down. Then it starts pulling back to the 15 one. By the time it reaches the 15, it's almost at the 34. So that's our turning point. If it turns there, and it does turn there, then we want to enter, in this case, a short in the direction of this. This is a warning for us. That's the possible early stages of a new trend. Does it make sense? Does it make sense for everybody? There's the uptrend. There's the rhythm, the structure there. There's the early stages of a new trend. Just as we saw when we looked at this one. This point in time is exactly, let's just go back here a little bit. This is exactly one of these hard spots. That's what we're looking for. We're looking for that hard spot. But we know not every changeover, not every sweet spot there is going to give us a good entry. That's what that's what we use the indicators for, to give us those exact, well-defined places where we want to enter. Okay. Let's say what Owen says here. Yes, we're looking for a low point and a new trend that you believe is going to go back. Okay, I don't understand your moving average numbers. Okay, let's go back here. My moving average, the moving average that I use, is set out. Oh, okay, Owen. Yeah, that's what I meant when I said when you don't know the don't understand the method, you can look at the full one. We explain every indicator in detail, but to help you, I'm going to go back to the presentation now. Let's just look at our rules. Okay, we basically use obviously the trend. Then we've got a 34 simple moving average. And we've got a 15 simple moving average. We use the fractal. We want the first decent fractal that breaks through this one, and then that starts pulling back the lowest, the lower or the higher one, depending if it's a long or a downtrend, or an up or a downtrend. And then we've got the momentum. Okay, where is the close of the second candle? Okay, Peter, that is where I changed it a bit. A lot of guys said that they get confused when we wait for the close of the second candle after this turn. So what I did is I listened to a few webinars of Bill Williams. I actually, one of the guys that I'm training told me about it. I couldn't believe it because it's very, very old. It's in the 70s, 80s, but it's actually, it's on there to listen on YouTube. So I listened to that because I wanted more insight into how he designed the fractals and what he used with the fractals. So after I listened to that, I decided to change the way we use the fractals a little bit more to come more in line with what Bill said, with the way he designed it. Now what he said about the fractals is the purpose of the fractal obviously is to identify a reversal point. And the way he uses this is, in this case, we're looking for a reversal point, a low, because we know the market is going lower here, broke through there. We want a reversal point and then a decent pullback from there. So now we haven't got a decent pullback here, still nooks and crannies. We've got another possible reversal point. It's always possible. And here we get a decent pullback. Right. So it pulls back, and instead of waiting for a turnaround here for the fractal that we used, what we're going to say is we want to turn around here, and when it crosses that lowest fractal, and here you'll see the correlation between 1, 2, 3 patterns. This is actually what Bill designed this thing for, is to show him 1, 2, 3 wave patterns, or wave the 1, 2, 3 wave structure of the markets, right? So what he did is he uses that as the 1, that's the 2, and if it breaks through this one, makes a 3 that's lower, that's his entry point, right? So that's how I changed the fractal, the uses of fractal in the spring method. So instead of waiting for the turn here and then 2 candles, you'll see here's a typical example of that. There was the fractal appeared there. There was a previous way we used it. There's a first candle, there's a second candle. So we only entered there. It happens quite a lot because remember, this is a change in the early stages of a new trend. So there's a lot of, because the price went high, there's sellers here. There's a lot of guys wanting to drive this market down. Right. So what we do is we change it a little bit. We take the lower one. We wait for a decent pullback, and then when it goes past that lowest one, then we enter there. We put a stop order in there. The problem with the close of the second candle again was, practically speaking, some people gave me feedback. It sounds nice in theory, but now you have to wait for the close of that second candle. So and sometimes the market goes, like I said, it's already here getting a lot of momentum here, and you're waiting and you get anxious, and especially if it makes a long one there, should you take it, should you not take it? When we change the use of the fractals a little bit, it just becomes a little bit easier. Hope it makes sense. No. Yonder, we don't wait for confirmation. We won't wait for the candle to close. What we're waiting for, remember, we are trading this market structure. Let's get back to that. We are trading this market structure. We're looking at the market structure. So if it's in that area, and our technique tells us it's pulling back to early stages, we put our stop orders in there. If the market starts ranging there or whatever, it goes up, we just pull it. But if it goes, then we are expecting a downtrend here, and we've got our entry there. It takes it. We've got our stop losses and our take profits here. It's a longer time frame, and it just goes in our direction, or not, and you protect your account. Okay. Some guys may feel like we're talking, what's this guy talking about? Just go over it again, go over it again. The idea is just, that's why I start with the structure of the market. We don't focus here. Let me take these trend lines away, or this horizontal lines away. Our focus remains on what happens here. There's an uptrend, and it's the beginning stages of a downtrend. These indicators just helps us to identify a point easier. For instance, let's go look at another example. Let's zoom a little bit back so we can see. That's the one we just discussed. You can see it's a beautiful uptrend. Do we see anything here, guys? Do we see anything here? This is a range. There's no entry there. There's no beautiful uptrend. There's perhaps 1, 2, but there's no third one. And then the market goes ranging again. Right. So there's no one there. Let's look here. There was a possible one. There's a higher rise, 1. Another high rise, 2. Another high 3. This is a trend. True. Here goes our 34. It breaks it. It goes up, but let's see where it goes now. It didn't go down, and now our moving average, our 15 is moving down here. There's a lot of volatility here, so we've got a warning here. It's pulling back past the 34 again, and now it's taking our first or second step. It's erasing. So now we have to wait again. And what it's done now, it's warned us. It's going back. It didn't go nice and down and make a nice drawdown to the or a pullback to the 15 that is below the 34. It's now in between there. So there's nothing there. So, and it was a warning in a sense because of all those that sharp down movement there. That makes the risk of such a trade huge. It actually puts it onto another time frame. So this is a warning. So it warned us to stay out there. Let's look for another one. Okay, do you see any trend here? I don't see any trend. What's the structure here? 1, 2, just a lot of noise here. Right? Let's see what happened here. Okay, I see another beautiful downtrend there. And again, we've got the same problem. It starts pulling back, and it only hits there it hits the 34, but now it's already made a few legs there. There was a lot of sharp movement there. So dangerous, very, very dangerous. So if you decided to take this trade, there was already, that was the first, it's already second leg of the second impulse wave of the new trend. And now it only submerged, or it came through this one. So it's a little bit delayed. It's even more delayed than the failure swing of the professor. So very, very careful. Theoretically, yes, it broke through there. That one's just invalidated. It went a tip too far. There it broke through. It came back, pulled back, and we had a possible setup there again. Personally, I wouldn't like this one because it's already the new trend is already, it's not the early stages of the new trend. It's already the middle stages of the new trend. But even if you decided to take this one there was the fractal, the highest fractal, and then the pullback to the 15. So there's where your entry would have been after that pullback, not that one. So after the pullback there, put your entry there. Stop loss would have been way back here, and you would have gotten at least a break-even trade here. That is the problem if you enter in the middle, of a new trend. is that there's not enough room left for you to get all your profit. So at least we got 1-to-1 here. If a guy wanted, let's say you and that's what the trap that I was stuck in for a long time. If I wanted actually 1-to-2 here, the market would not have given it. It was there, turned around, and now you don't know what to do. You take it out, stop, you get stopped out. Yeah, at least we saw now it's not an uptrend anymore. We've taken uh, um, our profit out somewhere there when it came back here. This is not an uptrend anymore. So take it out there and we've got some profit. We've got a little bit of profit. Shop. Another guy might have been at break even or something. Okay, let's take that away and let's look again. The idea is to apply this method. Where are we now? We still got time. Nice. Right. So let's see. We took this one. It's already middle. Now we've got an established uptrend here. Here it goes. Up 1. Not really. 2, 3. So there's an uptrend. Now what have we got here now? It goes up very high, comes down, doesn't break the 34, so we wait. And now there's a range. There's actually a wedge forming here. So we wait. Technically speaking, or very strictly speaking, we want a breakout, a pullback just after the trend. The moment it becomes a range, then, or it starts piffling, then what's the market going to do? There was a lot of, the price was very high. We're expecting sellers to come in after a range where there's a balance. We don't know what's going to happen. It can go anytime. So I wouldn't take that as a legal trade or as a very good trade anyway. Let's see, there's another. Godfrey asked another question. Would you recommend that our analysis be done from the higher time frame to the lower time frame always? Godfrey, you trade, you look for, on a time frame, you look for a trend, you look for that structure, and that's where you trade. You enter the trade there, you manage the trade there, you take your profit there. What you can do, because of the fractal nature of the markets, and the fractal nature simply means it's patterns within patterns within patterns within a monthly, or we should say a weekly, a single candle. If you go down to the 1 hourly or even the 4 hourly, you see a nice trends, full scale trends within that week candle. So that's patterns within patterns. So the way some people use that, and I'll show you now. Let's say, for instance, you were looking at the market and you were, let's choose a one. There's an uptrend going, right? So the uptrend's already going. We've decided that we don't like this noise, so we're not looking at it. But what are we seeing here? We're seeing a 4 hourly uptrend, right? So let's say it broke there, started going up, broke there, started going down. Now we know there's a good chance that because it's made a higher high, that there might come another impulse wave. This is a correction wave, another impulse wave. So what would happen if we looked at that candle and we went a little bit down? Remember, we cannot trade in this time frame, but we're just using the fractal nature of the markets to possibly identify in the lower time frame a nice trend, right? So let's go and see what happened inside that trend there. Obviously, not everyone is going to work. Let's go get our fixed position dongle here, put it here. Now we go to, let's say, the 30 minutes. 30 minutes, not such a nice pullback. Let's look at the 15 minutes. Oh, I have to go back. My dongle is out again. I think the 15-minute data is not up to date. Yes, I think so. 15-minute data only lies there. Let's go a little bit back. Let's allow the no. There's some standard settings, so there's not too much data loaded. So what happened is we have to go back to a little bit earlier because the 15-minute data didn't download up to there. Let's use this one for instance. Same principle, just another place. Right, we've got a uptrend there. We know this is an uptrend. went down there, down there. What we're seeing here is it's an established uptrend, and we see some higher time frame down movement there. What's going to be there if we go down to the lower time frames? Remember, we're looking for a trend. We're simply looking for that structure of ours. So let's go to the 15 now. Let's just anchor it again. It's a very handy little thing, this. You anchor it and then you don't have to jump around. So now we go to the 15. What do we see? So 4 hour, we see a couple of candles. We know it's an uptrend. It's a pullback in the uptrend. We go to the down, but to the 15 to a lower time frame. What do we see there? 1, 2, not a beautiful one, but a downtrend. We see a downtrend there. And they didn't give us a nice entry, but many times it will go break out of there, pull back, and give you a lovely entry. So that's the way we use higher time frames to look for opportunities on the lower time frames. But always in the time frame we look for that structure. We look for that sweet spot. This one didn't give us. Let's quickly look for one that did give us a proper or a nice entry. Let's just see. There's so many of them. There's also a down pull there, but it's not a very clearly defined one. There's a bit of noise. There's on the lower time frames. You can see there's going to be some noise. Okay, let's look at this one. We've got some noise here. It pulls back, goes back. Let's see how that one looks on the lower time frame. This is in its essence applied technical analysis, applied moving average spring strategy. This is what people do. They sit and they look for these things. They see the opportunity, they take the risk, and they make money, or they protect their account. This is how traders make money. So let's see what happened there. And this is part of the, remember the foundation, simple, well-defined method, proper money management. This is part of the mind part, discipline. Go train your eye, train on the old chart to see these things. As you train, it becomes easy to see. Then you go to demo and you practice on the demo. You practice executions until you can do it flawlessly. Let's go to the 15. Didn't use my own fixed one there. Let's just fix it there. Don't want to waste time here. Okay, another one. Didn't give us a very good entry there. Just whacked there before it, or just went very quickly there, past there, so it didn't give us a good entry. But many times, guys, you get a beautiful downtrend there, and then it's precisely what we're looking for. It breaks through the 34, pulls back to 25, and you might get an entry there. So in this both cases we didn't get an entry. Let's just look for one that we do, and actually I can show you one. Okay, we've got a downtrend here, got a pullback. I think the 15 minutes will go to there. See if we get a 15-minute one down there. This is part of the homework. This is part of the mind part which you master. Not actually the method that you master. You master the fact of seeing that rhythm, spotting the areas, and then using just a few indicators to highlight for you where to enter. Make it easy for you to enter. Let's go to the 15 there. Okay, there was almost one. So we had a pullback there, 1, 2, 3, broke down, pulled back, almost gave us an entry there. And you see how quickly that goes after that, because we have not a beautiful uptrend there, but remember what we saw there on the higher time frame. We saw a definite down move there, beginning of a down move on the 20 on the 4 hours, and that's the one we actually, no, it's not the one we analyzed, and we're expecting some down movement there, and then on the 15 there the down movement comes. Right, hope you're getting an idea. Frederick, let's just see, I've got some more questions here. We've still got time, that's nice. Thanks. What if in other time frame the reverse is the trend? Right. Now there's I understand what you mean. What I just explained, like in the 4 hours now, is I like to wait. I see a trend going. I see the beginning of a new trend, or it might be a higher time frame established trend. And then I wait for the corrective wave, and I only take the impulse waves. Now I've heard the prof say in a couple of his seminars, we don't know what's going to happen. So actually, you can take any turnaround. You can take the corrective wave turnaround as well. That means every single wave here on this time frame. Let me mark them. Every single wave here, a couple of candles here, on the lower time frame is going to be a trend that, technically speaking, that you can take. Right. Not all of them, all the corrective waves are going to be a proper, or the corrective moves like this one is going to be a proper downtrend or a proper uptrend on the lower time frame. But still, it gives you an idea. There is a downtrend. There is a proper pullback. We're going to look at the structure of the market in the lower time frame now. I'm just marking it here for you. So technically speaking, you can take every single one of those changeover points. We're actually looking at nice structure, but just from a higher view. So it went down again. Remember, in the lower time frame now, it's going to might be a little bit noisy. Okay, let's go look how it looks there. This is still spring moving with the moving average spring strategy. Right, let's zoom out a little bit so we can see from a distance. Okay, what do we see here? Here didn't give us a good entry, but there was a small uptrend there. There was not a downtrend, nothing. This is just a range. Here we've got, and this was marked on just the candles on the higher time frame. Yeah, there's some up movement there, not a beautiful one, but up movement. And what do we see here? Can you see what I see? We see a nice break of the 34. It goes down, makes a beautiful reversal point, a fractal there. It pulls back to the 15, gives us another fractal there. It doesn't always, but in the beautiful ones it does. And what do we have here? We have an entry here. Where's our stop loss? Stop loss is at the 34. Here we've got our first take profit around about there, and there we've got our second take profit. Okay, so there's an example of a trade. Let's look a little bit further. Let's just get rid of that rid of all those lines. Oh man, I took away all the lines I shouldn't have. Sorry guys, but even here, it's practice. We're looking to see the structure. We'll go a little bit back, and you see the up move there. I generally like to do this when there's no indicators. There's the down move again. There's up little waves, they're not a very nice one. Impulse wave, corrective wave. Corrective wave. Yeah, that is just a mango mousse there. Here we can see again a bit of mango mousse, but it goes down. And there we can see again the up part. So let's go and look. Obviously, when we zoom in, it's obvious to see there it gave us a very good entry. There, corrective wave, that's what I mean. Frederick, that's what I mean. Yes, many times the corrective waves doesn't give you a very good place to enter, because the momentum, the longer time momentum in this case is down. It's still a down move. So this is just a profit taking, or some guys getting out of positions and so on. Here again, let's just zoom in a little bit, see what happened here. We zoom in. Here it went out, broke out, came back to the 15. And there was another possible entry. Let's see what would have happened there. This is a simulation. I'm going to show you a quick way. Yes, we've still got time. a quick way to save you some time and to make it much easier. Let me just reset this. If you use your Fibonacci levels here to identify, to use your risk reward, right? Or to work out, to show your risk reward view. What you do is you double click on the, you actually make it a risk reward tool in a sense. So what you're going to do is you draw for yourself one. Just go get it there. Okay, I draw it in. I double click on it. I go to the properties and then I delete all those small ones. Delete. I only want one, and then two there. Make it let's say we make that our stop loss, and it's going to be our entry. It's going to be our take profit 1, and then we've got a 3. That's our take profit 3, and the rest we delete. Right, let me show you what happens now. Now the Fibonacci changes into a risk reward tool. So when we use the Fibonacci now, that's our 1-to-1. So that's if that is 80, then that's going to be 80, and that's going to be double 80. So it's just very easily shows you what's going to happen now. So where did we say we how you draw it? It will keep the properties there. How you draw it in is you go to the point where you enter. So that's 100 point. You enter it there. You click from there and you drag it back to where your stop loss would be at 34 in this case. Right, so now what you have a beautiful one is your risk there. There you see it already took your made the break-even trade there. You took off your profit there, but unfortunately it didn't do it. It just broke you out of break-even, took you out of break-even there. It's gonna happen sometimes, but you lost nothing here. Okay, let's see if there's. Okay, Frederick, I hope I answered your question. Okay, we've got a couple of minutes. Let's look at a few more of them. Right, we're on the 15 minutes now. We zoom a little bit back so we can see back. There we had a break-even trade there. Now we wait. Yes, it broke out there, pulled back, but it never went past our thing there. And the 15 was still behind there. We don't like the 15 to be. If we want to go up, the 15 must cross the 34 as well, as it did there. It must be very close at least. And you'll normally see when that crosses there, then our momentum. I don't even refer to the momentum so many times. It's just a visual confirmation. But if those two are very close together, then the momentum is usually also in the right place. Right, we've got a downtrend there. Let's see what happens here. There's a break out of one. Pulls back, but it pulls back nice and deep. So not a very nice one. Could actually have put an entry there, but it wouldn't have entered. And what I don't like about that is then the 34 is actually within the price there. It's within the move, that wave there. That's a bit dangerous. That's why I like it to break through and then just pull back to the 15, not past the 34 anymore. Okay, so that trade was invalidated there. Let's see what we've got here. Look at the time here. Oh, see, that's one of the things about a low time frame to be cautious about. We're practicing here, and it's good. But what do you see here? What is the problem here? Can anybody tell me what is the problem with this trade? Look at the time. It's 11 o'clock at night, Cyprus time. So what happens 11 o'clock at night? Volumes die down. Let's put the period separators here. That tells you that is the time when the markets are closed. Around about 10ish, 11ish, the volumes of the US market starts lowering. There's still people trading because it's a decentralized market. Banks are open all over the world, but when the big markets are open, that's when there's lots of liquidity. Okay, right. That's it, guys. Our time is also as always up. Is there any questions? Any more questions? Did you at least get a glimpse of what I mean when I say you first look at you first have to see the structure of the market. You're looking for that turnover point, and our method helps us to identify it. Right. You do get methods that identify it, like the reversals or the failure swing. It's a little bit earlier than mine, earlier than this method, and it's up to you to you still see the structure, but for you to decide which simple method you're going to use. Simple, well-defined method depends on you. People that tend to use this one, and it's not really mine. I just coined it, the moving average swing strategy. It's just a way of entering into the market. Lots of other people use it. They give it different names and so on. It's a little bit delayed. People that are more conservative like a little bit delayed. They want the confirmation of the break first, and they're willing to wait a little bit. Other guys are more risky, or they're willing to take more risk. They jump in a little bit earlier. That's where the failure swing comes in. So if it makes a lower top, and don't make a lower top again, but a higher top or a bottom on this case, sorry, then some other methods might show you a way to enter there. So let's say, okay, no questions for today. What are? Thanks, Owen. Okay, yeah, keep on practicing. But just before I sign off, again, the structure of the market. Your focus is always the structure. If I take away if I delete the different indicators here, what remains? What is the most important part here? The structure. This is where we look. This is where your indicators must make it clear for you where to enter. It helps you. It's just assistance. The price, the spot, the spot. A lot of my mentors, like I said, they just trade from this. They just see the structure, wait for a nice breakout there, and they've practiced it so many times that they see, what their method looks like, or they see a way the market behaves that they like, and they go in. So we are using the methods, we are using the indicators just to make it easier for us. Okay, signing off. If you have got any questions, please, let me just go back to my first screen there. Sorry. Just going to go back to the first screen there. If you've got any questions, we don't leave you guys here. We have support. There's my email address. Write it down. We've got Skype support groups. If you struggle with this, we make an appointment and we quickly check. I've got some traders that just for 5 or 10 minutes, once or twice a week, we connect. They show me what they're doing, and they're accountable. If they have trouble, we identify it and they can correct it and they go on. So it's the guys that put in the effort, that train, focus, practice. Remember that quote of Bruce Lee: "I don't fear the man that does kick 10,000 kicks once, but one kick 10,000 times." This is the focus practice that we want. And what we're actually doing is we are mastering that structure. The method is just helping us to enter that structure when we see that sweet spot, when we see that points. Right. If you grasp that, then you're well on your way, guys. Okay. Thank you very much. Goodbye.